If you're a founder, I want you to listen like your next funding round depends on it, because it might. An investor does not fall in love with your pitch deck. An investor falls in love with one thing, and that is certainty. Certainty that the company is real, the shares are clean, the product is owned by the company, the risks are known, and that the money will not enter a legal mess. A founder once came into my office excited. Great traction, great story. A serious investor was ready to wire funds. Then the investor asked one simple question: who actually owns the company's software? The founder laughed. We do. It's our app. The investor did not laugh, because investors do not buy vibes. They buy proof. The investor asked for the developer agreement. There was none. The app had been built by a freelancer. Payments were made, yes, but payment is not ownership. Ownership comes from a clear intellectual property agreement in writing. That investor paused the deal, not because the app was bad, but because ownership was uncertain, and uncertainty is expensive. So in this video, I'm going to walk you through what investors look at when they perform their due diligence. I'll break it down in simple language. With some of my client stories, of course, I'll be leaving out their personal details. If you're an investor, this becomes your practical checklist. If you're a founder, this becomes your investor readiness roadmap. Now, what is due diligence? Due diligence is the investor saying, before I give you money, show me the truth, show me the risks, and show me that the company is investable. And investors will investigate your documentation like a forensic accountant and a lawyer had a baby. Here is how it usually starts. You send a deck, you have a call, they like the vision. Then comes the email that changes everything. Please share your company documents. And that is where founders either look professional or they start sweating. The first thing investors check is the company formed properly? They want proof of incorporation, filings, the registered details, who are the directors, who are the shareholders, and whether the company actually exists in the eyes of the law. Because I've seen a situation where a founder raised money in a hurry and used personal accounts for everything. The investor later discovered that there was no company at the time all the monies were collected. The founder told himself, we will incorporate later. Later is not a legal strategy. Later is a risk. So founders, if you want to be taken seriously, your company must be properly set up and your basic corporate records must be clean. Next, investors check your cap table. This is where many deals die quietly. Cap table means who owns what, how much does each person owns, what promises have been made, what options exist, what convertible instruments exist, and whether there are hidden claims. I once knew a startup that was doing very well. An investor was ready to invest at a strong valuation. Then when the investor conducted his due diligence, something painful was revealed. The founder had promised equity to 5 people. One was for advising, one was for introducing investors, another was for helping with marketing, another was for building a community, and the last was for a friend who believed in the vision early. None of it was documented properly. Some people had screenshots of charts. Some had voice notes. One had a drafted agreement that was never signed. The founder thought those promises were informal. The investor did not see them as informal. The investor saw them as potential lawsuits. Because if you take the investor money today and those people sue tomorrow, the investor will be the one to suffer. So what do investors want here? They want a clean, accurate cap table. They want shareholder records that match reality. They want clarity on any promised shares. They want to know if any shares are subject to vesting. They want to know if they are safes, convertible notes, or any instrument that will later turn into shares. They want to know if any co-founder has left, but is still holding a large chunk of equity without vesting. Founders, this part is not optional. This is one of the first places investors test whether you are disciplined. Now let's talk about governance. The boring stuff that becomes very interesting when money enters. Investors check who has authority to make decisions, who can sign contracts, who can open bank accounts, who can spend money, what decisions require a board approval, what decisions require shareholders approval. I've seen founders who incorporated with friends and never clarified decision rights. Later, one director woke up and blocked the company's accounts. Not because the startup failed, but because the relationship failed. Investors hate governance chaos because when there is a dispute inside, product stops, customers suffer, and investor money turns into legal fees. So investors ask for board resolutions, shareholder agreements, founders agreements, and basic governance documents that show how decisions are made. Now the big one, intellectual property, the lifeblood. Investors want to see that the company owns what it is selling. This includes your software code, your brand, your designs, your content, your data, your domain name, and even your customer list in some cases. They want to see intellectual property assignments from founders, developers, contractors, and employees. Why? Because if the company does not own the product, then what exactly is the investor buying? Another startup I had a consultation meeting with had a beautiful product, but the CTO built the first product before incorporation on a personal laptop under a personal GitHub account. There was no founder intellectual property assignment into the company. When conflict started later, the CTO said, I can take my code and go. That single statement scared every investor on the table. Not because the CTO was evil, but because the company's ownership structure did not protect the assets. So investors check, do you have intellectual property assignment agreements signed by founders Do you have developer and contractor agreements that assign deliverables to the company? Do you have confidentiality clauses? Do you have a clear policy on open source? Especially if your code includes libraries that comes with obligations. Founders, if you do not have this, you are building a house on the land you do not own. The next thing investors check is your contracts and revenue reality. Founders like to say we have partnerships. Investors like to say show me the agreements. Investors will usually ask for your customer contracts, your vendor contracts, your partnership agreements, your terms of service and privacy policy, refund policy if you collect payments, and major obligations that can drain cash later. They are trying to answer one question. Is your revenue real and defensible? Are you exposed to liabilities you are not talking about? Let me give you a simple example. A startup told an investor that they had recurring revenue. Due diligence showed that it was mostly one customer on a month-to-month basis with no signed agreement, and the customer could leave tomorrow with no consequences. That is not a stable base. That is a fragile situation. Investors also check employment and team documentation. Who is employed? Who is a contractor? Who owns the work product? Who has confidentiality obligations? Whether anyone critical can walk away tomorrow and take the business with them. Because a startup is not just code. It is people, knowledge, relationships, and execution. Now let's go into compliance and regulatory risk. This is where founders try to change the topic, but investors will not. If you operate in fintech, health, education, logistics, crypto, lending, payments, or anything regulated, investors want to know what approvals you need, what rules apply, and whether you are exposed. I worked with a startup that was growing fast. Investors were impressed, but during due diligence, the investor discovered that the startup had been collecting sensitive customer data without proper privacy compliance, and the startup had no proper policies, no proper consent process, no proper internal controls. The investor did not want to inherit future regulatory problems that could explode after investment. So investors ask questions like, what licenses or approvals are required for your activity? Do you comply with data privacy rules? How do you store and protect your user data? Do you have KYC and AML controls if applicable? Do you have clear risk disclosures if you deal with financial products? Have you received any regulator complaints or warnings? Have you had any data breach? Even if you are at the early stage, investors want to see that you take compliance seriously. The next thing investors look out for is litigation and disputes. Are there any current lawsuits? Is there any threatened claim? Is there any dispute with a co-founder? Is there any dispute with a contractor? Do you have disputes with customers? Is there any intellectual property conflict? Founders, do not hide this. It almost always comes out. And when it comes out late, it looks like dishonesty, not a mistake. Then investors examine financials and tax. This does not mean you should have perfect audited accounts at an early stage, but you must have financial clarity. They want to see your bank statements and your transaction history. They want to see revenue records and invoices. They want to see your expenses and burn rates. They want to see your runway, how long you can survive, your debts and obligations, your tax filings and compliance, where applicable. They are looking for discipline, not perfection. Now let's talk about the investor's favorite topic, risk. Investors will always ask about the concentration of the risk. Are you dependent on one customer? Are you dependent on one supplier? Are you dependent on one founder? Is your product dependent on one third-party platform that can shut you down? They will ask about technical risk. Is your product secure? Is your infrastructure stable? Is there documentation? Is there handover risk if one person leaves? They will ask about commercial risk. Do you really understand your market? Do you have clear unit economics? Do you have a repeatable growth channel? Is your pricing sustainable? Due diligence is not just legal documents. It is the entire reality of your business. Now here is a key takeaway for founders. Investors investigate three things: ownership, control, and risk. Ownership means who owns the company and the product. Control means who can make decisions and whether those decision rules are stable. Risk means the problems that can destroy the company after investment. So how do you become investor ready? Start building your documentation like you are preparing for a court case. Because in a sense, you are preparing for the court of investor scrutiny. Have a clean incorporation file. Have a clean cap table and equity records. Have a founder's agreement or a shareholder's agreement that settles roles, vesting, decision rights, exits, and disputes. Have an intellectual property assignment and confidentiality agreement signed by everyone who creates value. Have clear contractor and employment agreements. Have customer contracts or terms that protect payment, scope, and liability. Have compliance basics, especially privacy and regulatory risk. Have financial records that tell a clear story. And finally, have a data room, a simple folder where investor can request documents and you do not start searching your WhatsApp, your email, and random PDFs at night. Because the founder who can produce documents quickly looks serious, and the founder who cannot looks risky. If you're a founder watching this, I want you to do one thing today. Ask yourself, if an investor emailed me right now to send my documents, would I look ready or would I panic? If the answer is you will panic, You do not need motivation. You need a proper structure. If you're an investor, use this as your baseline checklist and then go deeper depending on the industry. If you want, I can also produce a simple due diligence checklist that you can use as a founder and a due diligence checklist you can use as an investor, both in clean professional language. If you found this video helpful, subscribe for more startups legal breakdowns. And if you want a proper review of your startup legal documents before you speak to investors, send us an email through the link in the description.